stock market continues in a sector rotation play where the Russell 2000 and the Dow Jones Industrial Average continues to shape their outperformance against the mega cap technology S&P 500 and as well as the Nasdaq 100. And very interestingly, the small cap Russell 2000 managed to inch up to a fresh all-time high yesterday. The US dollar index managed to stage a 3-day of consecutive up move due to a mixed reading from the weekly US jobless claims data that was released yesterday as well. And very interestingly, the West Texas crude oil managed to stage a rally of 3.5% to trade at the 58 US dollar per barrel yesterday on the backdrop of a potential Russia sanction bill that could potentially punish countries that buy Russia oil supply. And gold continues to trade choppy below a key resistance level at the 4,500 mark. Very good morning to all and happy Friday. Welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the 9th of July 2026. So as usual, let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. All right, give me a minute just to make sure that everything is good. All right, losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Okay, so as usual, before we jump straight into the gist of today's daily dose, which is the intraday technical outlook chart, which I would like to share with you guys ahead of today's key risk event, which will be the release of the non-farm payroll data and as well as the all-important US employment rate. These two data could potentially shape the expectation of future Fed funds rate decision, especially where the market participants are still expecting the Fed funds to be to continue the Fed to continue its interest rate cut cycle heading into 2026 this year. So let's start with what has taken shape yesterday first. All right, so let me share with you the performance of the US stock market yesterday. Very quickly, let me bring you to the screen over here. Right, so what you could see on my screen over here is that the S&P 500 managed to close almost unchanged. The Nasdaq 100 inched down lower by negative 0.57% due to the underperformance of various mega cap technology stocks yesterday, where these mega cap technology stocks has a higher weightage in the Nasdaq 100 versus the S&P 500. So I could see it's a sea of red in the semiconductor, we call it in the sector, semiconductor industry within the technology sector, where NVIDIA, the juggernaut, closed down negative 2.15%, followed by Broadcom negative 3.21%, and a slew of other semiconductor stocks which also underperformed yesterday as well. And very interestingly, we start to see outperformance in the industrial sector, and this industrial sector is a heavy weightage in the Dow Jones Industrial Average. So what causes the industrial sector to outperform yesterday was industrial sector. There are various defense-related stocks related into it, like Lockheed Martin will be one of them that produces weaponry for the US economy, where Trump yesterday made an announcement saying that he demanded additional 100 billion increase in annual defense spending. All right, so this also come in light with that a rather shocking we call it removal of Venezuela leader last weekend, where Trump right now has kind of indirectly put Venezuela into the administration of US indirectly. All right, and that is the key movement that has taken shape in the US stock market yesterday. And also want to share is that the Russell 2000 was the top performer, up by 1.11% over here, and the movement of Russell 2000 allowed the Russell to stage a fresh all-time high yesterday. All right, as it continues to outperform the S&P 500. All right, so this was the high that was being made yesterday, closed at 2,604, breaching above the previous all-time high that was made in the 12th of December over here, right, previously. So very clearly, a clean breakout with a bullish Marubozu candlestick that is being formed yesterday on the Russell 2000. So what does it mean for the US stock market right now? So like I explained earlier on to you guys, for those who follow my daily dose, the year of 2026 will be the year of the laggards. That means the outperformance of the Russell 2000 small cap company and the Dow Jones Industrial Average, overshadowing the prior 3 year of outperformance that's being seen in the mega cap technology stocks, which is the Nasdaq 100 and the S&P 500. So what I'm saying over here is that the Nasdaq 100 and the S&P 500 will still continue to maintain its uptrend, right? Because we cannot see divergence between these key benchmark US indices in terms of directional movement, all right? So if the Russell 2000 and the Dow Jones continues to churn upwards, the S&P and the Nasdaq 100 will follow as well. It's only that the magnitude of increase right now will be centered on the Russell 2000 and the Dow Jones Industrial Average for almost at least in the first half of 2026 due to a sector rotation play. As long as the US economy doesn't collapse over here, which is being shown in the ISM services PMI data that I explained to you guys yesterday, that that hit to a level that is the highest since October 2024. And also we're going to see some kind of softness in the labor market, prompting the US Federal Reserve, which is the central bank, to continue its easing cycle heading into 2026. So it's more like a Goldilocks economy for the US. So but bear in mind that there'll be some kind of shock that's going to take shape. Will be geopolitical risk factor that is still in the forefront right now, because be aware of, all right, over here. So that is for the state of the US stock market. So like I explained earlier on, the S&P 500 and the Nasdaq 100 will continue to remain in its broad-based uptrend, supported by a positive market breadth that is still intact. So this market breadth I'm going to share you guys over here is the percentage of Nasdaq 100 stocks trading above their 20-day and the 50-day moving average, and as well as above their 200-day moving average. And at the bottom of the chart over here will be the number of S&P stocks trading above the 20-day moving average as a percentage of S&P stocks trading, S&P 500 component stocks trading above their 20-day moving average, and percentage of S&P 500 component stocks above the 50 and above the 200-day moving average. So all 6 metrics over here showing market breadth are still positive in the Nasdaq 100 and as well as the S&P 500, where the component stock of the Nasdaq 100 above their 20-day moving average is still healthy, above 50%, which is at 57%, based on the closing price of yesterday US session, which is 8th of January. And very similarly, the percentage of Nasdaq 100 stock trading above the 50-day moving average is also hovering a healthy blip above 50%, which is at 57%. Very similar for the S&P 500 component stocks as well, trading above the 20-day moving average at 68%. And the S&P 500 component stocks trading above their 50-day moving average is at 69% and showing further improvement. As you could see, a higher high over here. Very similarly, almost a higher low on the percentage of S&P stocks trading above the 20-day moving average. So overall, market breadth in this heavily weighted mega cap technology stocks that are centered on the AI play are still in a healthy market breadth. It's only that the sector rotation play right now, where market participants are much more favoring lower value Dow Jones Industrial Average and the Russell 2000, thereby creating a much more stronger momentum or bullish momentum in this prior laggard, which was being the lagging play in the last 3 years, which is the Dow Jones and the Russell 2000, now taking a leadership role in at least in the first half of 2026. All right, so that's for the state of the US stock market. Now for the state of the FX market, so we know that FX market, we start to see some kind of dollar strength in the last 3 trading session over here. So let's look at the US dollar index. So the US dollar index continues to bounce since this Tuesday over here by 3 candlesticks. But if you look at the movement of this candlestick, the body of the candlesticks is rather small over here. All right, so it's very small body candlesticks, indicating that yes, it's going up move. But this up move of a small body candlestick represent a lackluster bullish momentum. And as we are speaking right now, the price action of the US dollar index, so let me, this is the US dollar index on the daily time frame chart, is now back at a intermediate resistance zone, which is the 20-day moving average, the 200-day moving average in orange over here, and the one in dark blue, which is the 50-day moving average which confluence with this graphical resistance zone at 98.86 and 99.23. And right now, the body of the candlestick is now forming a daily doji candlestick right before the release of that non-farm payroll data and the US unemployment rate, which later I'll share with you guys what are the consensus later on in the last part of today's daily dose. Yes, 3 days of movement on the dollar index rallied, but it's now coming to an inflection point where we could potentially start to see some form of minor bearish reversal to take shape on the US dollar index, potentially retesting the 20-day moving average again over here. This zone here. Okay, at 98.43, 98.28. Okay, so that means there could be some form of US dollar weakness creeping back into the market based on the price movement of the US dollar index as we are seeing right now. Okay, over here. And one particular news I will share is that causes the oil price to actually spike up was this, where is it over here? Yeah, this is the one. So there's this bill that is potentially may pass next week by US Senate, which is the Congress, as well as the Congress, Russell sanction bill. So this Russell sanction bill is, there'll be a vote coming into the US Parliament or US Congress this week, and it will allow US President Trump to punish those countries who buy cheap Russian oil fueling Putin's current war machine. So if this bill is being passed, there'll be less demand for Russian oil, and the demand could skew back towards other oil, other type of oil, like for example the West Texas crude oil producing out for US. That causes the West Texas crude oil to rally up to 3.5% yesterday, to trade almost close to the psychological level at $58 per barrel. So bear in mind, those who followed my daily dose this week, I do mention that the WTI crude oil is still trading in a very sideways range. It hit the lower limit of the range where 2 days ago we flipped to a bullish bias, and this bullish bias has been met by our resistance, hit the resistance level yesterday as it trade to the upper limit of that range. Okay, later I'll share with you what is the current intraday technical outlook on the West Texas crude oil as we cover the second part of the daily dose. Now, before we jump into the second part of the daily dose, let me touch you through the Tier 2 US data released yesterday, which is the mixed reading of that weekly jobless claim that allows the US dollar index to trade higher yesterday for the third consecutive session. So this weekly jobless claims over here. So this weekly jobless claim data is a very volatile data over here because every week it will release. So this continued jobless claim data is the raw data for the week ending 27th of December. So this jobless claim data, it came in slightly higher than expected. So market is expecting 1900K jobs and more jobless claim, continuous jobless claim. That means this is coming like a government support. All right, so if there is more jobless claim, it means that the labor market is weaker. All right, over here, given that there are more people out of job seeking out help from the government. So market is expecting 1900K in K jobless claim, but it came in slightly higher at 1914K. But given that this is a very volatile number because every week, so if you look at the jobless claim based on a 4-week average, that means it's move up according to a moving average, a 4-week moving average, it came in below the previous month of the previous week, pardon me, not month, the previous week of 219K, it came in at 211.75K. So if you look at the jobless claim based on this moving measure over here, it actually dipped down over here, all right, dipped down quite significantly. So that actually causing a bit of what I call it a mixed picture in both of these weekly jobless claim data, both on the headline basis and on the 4-week moving average. And that also allows the market bets to remain high that the US Federal Reserve will do nothing on the 28th of January 2026 after cutting rates for 3 times in 2025. So high chance that almost 90% chance that the Fed will stand pat to maintain that Fed funds rate at 3.5% to 3.75%. And with that rather strong ISM services PMI data that was released on Wednesday, yesterday mixed reading in the weekly jobless claim data on a aggregated basis over here, we continue to see the next Fed rate cut chances being a pullback. Only 45% chance that market is now expecting the Fed will cut on the 18th of March 2026 meeting. So prior to the release of the ISM services PMI data and yesterday's weekly jobless claim figure, in Tuesday, the possibility was around 53 to 54%, a slight chance, slightly above 50% chance that the Fed may move another cut on the next meeting in 18th of March over here. But these chances has been reduced, and right now market participants in the Fed funds futures market are placing a higher chance of 63% on the 29th of April meeting, and another potential cut. The fifth cut will come in at the 86% chance much later on the 16th of September 2026 FOMC meeting. So overall, by the time we hit the last meeting of 2026, which is on the 9th of September, market participants in the Fed funds futures market is expecting at 76% chance that the Fed funds rate will be at 3% to 3.25%. So that actually implied at least a 2 interest rate cut so far being baked in of 25 basis points each in the Fed funds futures market, as being compiled by data from the CME Fed Watch 2. So given that the Fed are still in the mode of cutting rates, it's only that which particular date that will cut over here, and that pretty much depend on today's release of the non-farm payroll data, the unemployment rate, and as well as one more key tier 1 data, which will be the University of Michigan consumer sentiment data that will release later at 11 p.m. Singapore time. Later, I'll touch more about that. All right. So with that, let me now touch on the second segment of the daily dose, which is the intraday technical outlook segment over here. So before that, let me expand my screen. All right, just okay. So let us go to the second segment, which is the intraday technical outlook segment, starting with the FX market. Okay, so let us start with the euro dollar over here. Right, so before I touch on the chart of the euro dollar on the intraday chart, it's very good to take a bigger picture look at the daily time frame of the euro dollar. So the daily time frame of the euro dollar, it continues to trade in this major uptrend phase that is highlighted in green. So this is the daily chart of the euro dollar. Let me expand my screen. So very clearly, it's trading in this uptrend phase since the low of January 2025. So what we could see over here is that since hitting the high of 2nd of July, it has been consolidating. Right, and this consolidation could become in the form of a bullish ascending channel. And what we could see in the last few days since the Christmas break, it's been shaping that pullback, and now that pullback has reached the 50-day moving average, which is also the former overlap and the former minor swing high, medium-term swing high of 13th of November 2025 that managed to stage a rebound that give rise to that post pre-Christmas rally from 9th of December all the way up to 24th of December, and now market is back to this level again. And what's interesting over here is that yesterday we flipped to a neutrality stance, waiting for the price to come back to that 50-day moving average, which is at the 116.40 level, which is the lower limit of our neutrality range that we have yesterday. And what's interesting now is that we now start to see price action shaping a bounce right exactly at the 50-day moving average, and also the daily RSI has now starts to stage a bullish breakout. We could see over here as we are speaking now. Right, previously there's this resistance and there's a bullish breakout, and prior to this bullish breakout, we see a higher low that is being flashed out on the hourly RSI after hitting a extreme oversold level that is much more oversold than the previous occasion of 5th of January and 17th of December. So indicating that there is some form of bullish momentum coming back into the euro dollar right ahead of the release of the non-farm payroll data, and very interestingly, resting exactly at the inflection level of 116.40. So hence, we will flip back to a potential bullish bias stance for a minor potential bullish reversal scenario that may unfold in the euro dollar using 116.40 as my short-term pivotal support for today, that confluence with the rising 50-day moving average. First resistance level to watch will be at 117 figure level, followed by the all-important 117.28 upside trigger level, in order for the return of another bullish impulsive upward sequence. Why 117.28 is an upside trigger level? Because it confluences with two important technical elements, will be the 20-day moving average, and as well as this minor descending trend line that kept previous rally since the Christmas break high of 24th of December. Only a bearish breakdown and an hourly close below 116.40 will invalidate today's minor bullish reversal scenario to see the continuation of this corrective decline sequence unfolding much further towards the downside, threatening to expose the next near-term support level at 116.60, 115.90, maximum 155.50, which confluence with the 200-day moving average. So that's for the euro dollar. Next up will be the sterling pound over here. So the sterling pound also drifted down towards the lower limit of our neutrality zone yesterday, where we flipped to a neutrality stance at around the 134 figure level, and also now trading above this 200-day moving average as well. And what's interesting over here is that the hourly RSI also has started to shape a series of higher low over here. And if we do that descending trend line, we also managed to stage a bullish breakout as well in today's Asia session. So with this positive reading on the hourly RSI, we will flip back to a potential bullish bias for a potential minor bullish reversal scenario that may occur on the sterling dollar today using 134 figure / 133.85 as my short-term pivotal support zone, which confluence with the rising 200-day moving average. Two key resistance level to look out for today on an intraday basis will be 134.50, 134.90. Above 134.90 may see a retest of that this week minor swing high area at 135.50, 135.80 next. Only a bearish breakdown below 133.85 and the hourly close below it will invalidate today's minor bullish reversal scenario to see the extension of this corrective decline sequence unfolding further towards the downside, threatening to expose the next near-term supports area or support levels at 133.50, 133.20, maximum 132.87, which confluence with the rising 50-day moving average as well. Right, so that's for the sterling dollar. Up next will be the Asia Pacific currency, starting with the Aussie dollar. All right. So the Aussie dollar managed to play around at this, didn't actually do a proper breakdown below this minor ascending channel support that we have in place since 21st of November 2020-25 low over here, and also shaping a higher low, as we could see over here, a higher low right above the rising 20-day moving average. So with that, I will be watching this 20-day moving average, which is also confluence with the minor swing low area of 31st of December or 5th of Jan. So it's a zone 0.6670, 0.6660 over here. So using a slightly adjusted downward pivotal support zone at 6670, 6660 to maintain this potential minor bullish reversal scenario that may take shape on the Aussie dollar for today. First resistance level to watch will be 67.20. A breakout above 67.20 may revisit the 11th of October 2024 high that got rejected on 7th of January at 67.60 next. Only a bearish breakdown below 66.60 and with the hourly close below it will invalidate today's minor bullish reversal scenario to see the extension of this minor corrective decline unfolding further towards the downside. Towards the next intermediate support levels to watch will be at 66.30, followed by 65.90, that confluence with the rising 50-day moving average. So that's for the Aussie dollar. All right, and that also, that's for Aussie dollar. Next up will be the dollar yen over here. So the dollar yen broke above our upper neutrality zone, which is 157 figure level. So given that it has broken above our upper neutrality zone, we will flip to an intraday bullish bias for the dollar yen using 156.30 as my short-term pivotal support to maintain this intraday bullish bias. We also confluence with the rising 20-day moving average above 157.28, which is the minor swing high of 5th of Jan. Potentially may see a further push up to test the next intermediate resistance level at 157.88, which is the minor swing high of 20th of November 2025 before this choppy movement takes shape on the dollar yen. All right, only a bearish breakdown below 156.30 will invalidate today's intraday minor bullish push up towards the range top, then see it floating down towards the range support level at 155.90, maximum 155.35, which is the minor swing low area of 17th of December and 19th of December, and also correspond closely with the rising 50-day moving average, both these two support level, which is the 155.90 and the 155.35. So that is for the dollar yen. Flipping to a intraday bullish bias for a push up towards the range at 157.88, which is the range resistance of 19th of December and 20th of November, after breaking above our upper neutrality zone yesterday at today, which we highlighted yesterday at 157 figure level. All right, so that sum up all the intraday technical outlook on the four major US dollar pair. Let us now proceed with the Asia Pacific stock market. Okay, highlighting the Hong Kong 33. Let me expand my screen. Right, so this will be the Hong Kong 33, kind of trading sideways again. Can't break above our first resistance level that we highlighted, 26,440, but still holding above our pivotal support zone at 20 short-term pivotal support zone at the 25,915, 25,800 level, which confluence with the 20-day moving average and the lower limit of this minor ascending channel in place since 16th of December 2025 low. So net overall, we still can't have a bearish bias because it's still holding above the pivotal support level. So I'm still watching the pivotal support zone closely at 25,915, 25,800 level, short-term pivotal support. And I will have an upside trigger level at 26,440. Only a bullish breakout above 26,440 will increase the odds of another round of bullish impulsive upmove sequence unfolding. That means potentially ending this minor corrective decline that has taken shape since 6th of January 2026 high, all the way down to the low of yesterday, 8th of January, which is a 3.35% corrective decline. All right, so only a clear breakout above 26,440 may potentially end this minor corrective decline wave over here. Then therefore seeking out the next intermediate resistance in today at 26,656 next. Only a bearish breakdown below 25,800 that would invalidate the potential minor bullish reversal scenario to see this minor corrective decline unfolding or extending further towards the downside, exposing the next near-term support level at 25,545 next. A breakdown below 25,545 will expose the double bottom key minor swing low area at 25,110 next. So that's for the Hong Kong 33. Next up will be the Nikkei 225, which is the Japan 225, represent Nikkei 225. So the Nikkei 225 yesterday, we do have a short-term pivotal resistance at 51,888, where we want the price action to come down to shape that residual corrective push down, thereby hitting our support level at 51,050. So it printed a intraday low of 51,055, give or take, is almost hitting that level and shape a bullish reversal candlestick. And where this bullish reversal candlestick formed, it formed exactly at the lower limit of this minor ascending channel that has been in place since 18th of December. And what we could see right now is that the hourly RSI shape a higher low and as well as a bullish breakout over here. Therefore, confirming the potential end of this residual push down that is being seen yesterday, right exactly at our support at 51,050. So using 50,720, a slightly lower key support level to watch out for today, because it could also confluence with the 20-day moving average. So we will now flip back to a bullish bias stance given the positive development that has taken shape yesterday, right now on the Japan 225, representing the Nikkei 225. So 50,720 short-term pivotal support level, flip back to a bullish bias stance on the Japan 225. Next two resistance level to watch out for today on the intraday basis, 51,888, followed by 52,415. Above 52,415, we'll see a probe towards the next intermediate resistance zone at 52,775. 53,045, which confluence very closely with the upper limit of this ongoing minor ascending channel. Only a bearish breakdown below 50,720 will invalidate today's bullish bias move on the Japan 225 to see another choppy corrective decline sequence unfolding, exposing the next near-term support level at 50,180, followed by 49,520. Right, so that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 continues to churn upwards, holding above our key intermediate support level that we highlighted yesterday at 25,065 over here. So I don't want to push it too tight at 25,075. I'll still use 24,860 as my short-term pivotal support level to maintain this ongoing bullish biasness in the Germany 30. Next resistance level to watch for on the intraday basis will be 25,433, which is a Fibo extension cluster level. Only a bearish breakdown below 24,860 will invalidate this bullish direct push up on the Germany 30, representing the German DAX, for another round of minor corrective pullback to see a retracement, exposing the next near-term support level at 24,670, maximum 24,430, which confluence with the rising 20-day moving average and this lower limit of this ongoing medium-term ascending channel that has been in place since 21st of November 2025 low. All right, so that's for the German 30, still maintaining that bullish bias. Next up, Next up will be the major US stock indices. That is starting with the US Wall Street 30. So the US Wall Street 30 bounced up as expected over here, right at the former pullback support of that minor range resistance of 12th of December and 26th of December, and shape a very strong bullish reversal that came in within our expectation. So with this strong bullish reversal, I will shift my pivotal support upwards to this all-important pullback support zone at 48,870, 48,770 for today, and maintain that ongoing bullish biasness on the US Wall Street 30. Next resistance level to watch will be the current all-time high area at 49,606, followed by 49,805, 49,840 next, which is a Fibo extension cluster level. Only a bearish breakdown below 48,770 will negate this bullish bias tone to see it another round of minor corrective decline, retesting the rising 20-day moving average at 48,480. Only a bearish breakdown below 48,480 will open up scope for a deeper minor corrective decline towards the key bullish reversal low of 2nd of January at 48,100/47,870, which confluence with the rising 50-day moving average. So net overall, still maintaining a bullish bias on the US Wall Street 30 for today, representing the Dow Jones Industrial Average with a tightened adjusted pivotal support zone at 48,870, 48,770. Next up will be the S&P 500. So the S&P 500 managed to bounce exactly at our pivotal support zone that we have yesterday at 6,900, 6,880 level, which confluence with the 50-day moving, which confluence with the 20-day moving average as well as the lower limit of this medium-term ascending channel that I drew from the low of 21st of November. So still no change in terms of the key levels to look out for. Maintain that potential bullish bias on the S&P 500 using the same pivotal support zone that we have yesterday, 6,900, 6,880. First resistance level to watch will be the current all-time high area at 6,969. Above 6,969, open up scope towards 7,000, 7,005, which is a Fibo extension level of 0.764, taken from the low of 18th of December. Only a bearish breakdown below 6,880 and an hourly close below it will invalidate today's bullish bias to see another round of choppy minor corrective decline sequence unfolding, retesting the next intermediate support level at 6,822, which confluence with the 50-day moving average. So that's for the S&P 500. Next up will be the Nasdaq 100 over here. So Nasdaq 100 continues to hold above the 20-day and the 50-day moving average despite yesterday earlier sell-off, and also managed to hold above our pivotal support level at 23,355 and still can't break above this stubborn 8 December to 12 of December range top at 25,760, 25,830. So still maintain that bullish bias over here with two key resistance level to watch. First resistance level will be yesterday's US session high, 25,655, followed by that stubborn range top of 8 of December to 12 of December at 25,760, 25,830. Only a clear bullish breakout above 25,830 with an hourly close above it that could potentially see a fresh bullish impulsive upmove sequence taking hold on the Nasdaq 100, exiting from this stubborn range top to potentially seek out the next two intermediate resistance at 26,107, followed by the current all-time high that was printed earlier in 30th of October last year at 26,290 in the first step. Only a bearish breakdown below 25,350 will invalidate this bullish bias on the Nasdaq 100 to see a choppy downward corrective movement to retest the 2nd of January minor swing low area at 25,133. A further breakdown below it exposes 24,870 next. So that's for the Nasdaq 100, still maintaining a bullish bias at 25,350, but price action got to break up above the stubborn range top of 25,760, 25,830 to see a much more forceful, bullish, impulsive upmove sequence unfolding back into the Nasdaq 100. All right, so that sum up all the intraday outlook on the major stock indices. Let us now proceed with the commodities market, starting with Gold XAU/USD. So Gold XAU/USD continues to struggle below our short-term pivotal resistance zone at 4,485, 4,500 that we have for the early part of this week. Yesterday, price action drift down to our intermediate support level at 4,430, 4,403, come break below it and trade higher. So it seems to be trapped within this zone over here right now. And the hourly RSI continues to be reacting off a descending trendline resistance over here and attempting to actually shape a bearish breakdown as well. All right, at this point in time. Right, so indicating the lack of upside momentum. So with that, I'll be watching very closely the 4,485, 4,500 short-term pivotal resistance level, still having a slight bearish bias on Gold XAU/USD. So in order to increase my bearish bias on Gold, Gold got to faster breakdown 4,403, which is the lower limit of our intermediate support zone. A breakdown below 4,403 will see it floating down towards 4,333. Potentially 4,309 next, which is the gap up that is being seen in the start of this week, which is on Monday, and as well as the 2nd of January minor swing low at 4,309. Only a bullish breakout above 4,500 and an hourly close above it will invalidate the bearish bias to see another round of bullish impulsive upmove sequencing, retesting the current all-time high at 4,550, 4,560 before the next potential resistance come in at 4,645, a Fibo extension level, and as well as the upper limit area of this ongoing medium-term ascending channel that has been in place since 20th October 2025 low. So bear in mind, whatever bearish bias I have for Gold XAU/USD is in a minor time frame. That means it's a minor corrective structure rather than the start of a medium-term trend phase, right? So overall, the medium-term uptrend still remains intact for Gold XAU/USD. All right. Then lastly will be the West Texas crude oil. So West Texas crude oil, we do have a bullish bias. Bullish bias squeeze up exactly at the upper limit of this complex sideways range configuration that has been in place since 16th of December. Rejected right exactly at the 50-day moving average, which is our resistance zone, targeted resistance zone as well, and rejected right exactly at this medium-term descending trend line that has been in play, that has previously kept previous rallies since 31st of July 2025 high. So with that resistance level being made, we will now flip back to a bearish bias stand for it to float back down towards the range, lower limit of the range again, using this all-important short-term pivotal resistance zone, 58.7, let me expand it, 58.76, 59.18, flip back to a bearish bias stance for the West Texas oil to float it back down towards the lower limit of this complex sideways range that has been in place since 16th of December. First support level to watch 57.74, followed by 57.15. A breakdown below 57.15 may expose 55.75 next. Only a bullish breakout above 59.18 and an hourly close above it will invalidate today's bearish bias stance to see the extension of this corrective rebound rally, exposing the next intermediate resistance area at $60 and 60.56, which is the minor swing high of 5th of December. All right, so that sum up all the intraday technical outlook on the broad-based cross asset classes. Now let us move on to the economic calendar. So before that non-farm payroll data, let's take a look at what other key data that may occur before the US session takes shape over here. So during the European session, we have one data, which is the retail sales data at 6 p.m. Singapore time, year on year for the Eurozone for the month of November. Market is expecting a slight improvement to 1.6% from previous October print of 1.5%. And most importantly, thereafter, we will have this non-farm payroll data releasing at 9:30 p.m. Singapore time. So market is expecting a slight dip to 60K from the previous print of 64K. And the unemployment rate is slightly improving to 4.5%. So market participant is looking very closely at the unemployment rate. Why? Because the unemployment rate at 4.6% previously was a very significant higher over here. So if you look at the 10-year trend at 4.6 level, it was the highest level since September 2021. So if it continues to maintain at this 4.6 level and surpass above expectation, or even was still at 4.7% level, that could indicate further softness in the US labor market, and that could also potentially change the rate cut expectation that is being penciled in by the Fed Funds futures market, bringing forward much earlier of the next cut that may come in the March meeting. Right, so this is something to look out for. And thereafter, this has not ended yet. So after the US session gets underway, we will have another key data to take note of. At 11 p.m., the University of Michigan Consumer Sentiment Data. So this is a flash data for January. Why consumer sentiment data is important? Because it's a tier 1 leading US economic data that potentially could impact retail sales in the US in the months ahead. Why? Because retail sales is also part of the services industry in the US that contribute close to three quarter of US GDP growth. So market participants expect consumer sentiment data to improve slightly to 53.5 from 52.9. So if you look at the trend of the University of Michigan consumer sentiment data, it's still trading in a broad-based downtrend over here. All right, so you look at the 10-year trend. All right, it's still inching downwards. So this one is, let's put it in the line. Yeah, very clearly. All right, it's still trading in the broad-based downtrend over here. So previous print was at 52. November was 51. It almost hit a all-time low, retesting the all-time low that was printed in June 2022. That was during that stagflation fear period, and also on the onset of the US-Russia war. That was at 50 points. All right, so during November, it almost hit the current all-time high at 50 low. So right now, market participants are expecting a slight bounce to 52 from 52.9 in December to 53.5. So if it came in within expectation, that is still considered a lackluster number. But if it's way below expectation, especially at 52, which is below the previous month print of 52.9, that could indicate rather weak consumer sentiment in the US economy, and that could also support this ongoing interest rate cut cycle by the Fed in 2026 as well. So that could potentially influence the FX market and as well as the major stock indices movement. So something to look out for, that will be at timing. Let me show the timing again. 11 p.m. Singapore time. Then thereafter, at the same time, we have another Federal Reserve official speaking, Fed Kagastri, at 11 p.m. Singapore time. Then thereafter, at 2:35 a.m. Singapore time, on Saturday, we have Fed banking speech as well. All right. So that sum up today's Daily Dose of Market Insights with the relevant key data / events to look out for today, and as well as the key intraday technical outlook charts that I shared with you guys earlier. So I wish you all a great Friday ahead, as well as a restful weekend, and we shall speak again on next Monday. Thank you.